Hey everybody, Joe here from Avalon. In this video, I'm going to answer the most common question we get from small business owners. What's the best way to pay yourself from your corporation? We'll look at the two options, paying yourself a salary versus paying yourself dividends. We'll discuss the pros and cons of each method and use some examples to find out which method saves you the most in tax. So all that and nothing else coming right up. All right, first up, we'll look at paying yourself a salary. We could use the term wages, salary, employment income to mean the same thing. So if you've ever had a job at some point in your life, this type of income is going to be pretty familiar. You receive a pay stub every couple of weeks that shows your income and payroll deductions like CPP, EI, and income tax. You also receive a T4 slip at the end of the year that you can use to report your earnings on your personal tax return. How salary works is that the payments become an expense within the corporation. The expense in the company reduces the corporation's taxable income, which also reduces corporate taxes owing. Your earnings will then be considered employment income for which you'll receive a T4. So you can get a deduction in the company and then the income is taxed in your hands as employment income. Paying yourself a salary can be a great way for you to earn steady and predictable personal income. So let's take a look at some key advantages when paying yourself a salary. First up, paying yourself a salary will allow you to build RRSP contribution room, whereas paying yourself dividends does not. So this is an important consideration if you want to continue investing through your RRSP. If you pay yourself solely through dividends, you won't build RRSP contribution room, and you may not be able to continue investing in your RRSP. For more info on RRSPs, check out our RRSP guide linked in the description below. One really nice thing about paying yourself a salary is that your annual personal tax bill will be less of a surprise. Income tax is withheld from each paycheck and then remitted to the receiver general. This means that when you file your personal tax return, you will have already paid taxes on your income, helping you avoid that surprise tax bill once you file your tax return. When paying dividends, income tax isn't withheld or remitted at each payment. Paying yourself dividends can often create a personal taxes owing in April when you go to file your return. The surprise tax bill is a common scenario that we see, especially with those who are new to paying themselves through dividends. If you find it difficult to save money for an annual tax bill, then choosing salary and paying tax on each of your paychecks is probably the best way to go. Paying yourself a wage allows you to contribute to the Canada Pension Plan, whereas paying yourself in dividends does not. Now, this is a double-edged sword though. So contributing to a Canada Pension Plan allows you to benefit in the future when you collect CPP, but it also means that the CPP contributions are an expense when they're deducted from your paycheck. They're also an expense to the business because the company has to match your CPP contribution. It boils down to less cash now from paying CPP contributions, but more cash, hopefully, later when you collect CPP. If you are planning on relying on this Canada Pension Plan when you retire, this could be a big reason to pay yourself a wage. If you have other retirement savings plans, then this is probably less of a worry for you. Another situation when wages could be beneficial is when you're attempting to qualify for a mortgage. Banks like to see steady, predictable income, and earning a salary will help show that steady employment income. If you are considering buying a home in the next 2 years, then it might be good to also consider paying yourself a steady salary from your company. An often overlooked benefit to wages is that they can help you qualify for government subsidies and tax credits. There are a number of tax credits and government subsidies where the business must pay wages to even qualify for the program. Notably, the Canadian Emergency Wage Subsidy that was created during the COVID-19 pandemic required a business to be previously registered for a payroll account to qualify. Some personal tax credits, like the Canada Workers Benefit, also require that you've earned employment income to receive that tax credit. This factor alone may not be enough to sway your decision, but it is something to consider when choosing between dividends and salary. Now that you have an idea of when you might choose to pay yourself a salary, we should probably discuss how to do that as well. So to pay yourself a salary, the corporation will need to register for a payroll account with a CRA. And this is a big one, so listen up. Each time you are paid, the corporation will need to withhold source deductions, that's CPP and income tax, from your pay. These source deductions are then remitted to the receiver general on a regular basis. So if you're late in remitting these deductions or fail to do so, you could be in for some stiff penalties. So make sure you have a system in place or someone to keep you accountable to pay those each month. In addition, each year the corporation must prepare and file T4s for any employees that earn wages. For more information on how payroll works, check out our step-by-step payroll guide linked in the description below as well. All right, next up, we'll look at paying yourself dividends. Paying yourself a dividend is a simple way of getting money out of your corporation and to you personally. The process of paying yourself dividends is simple and quite different from paying yourself a salary. Dividends can only be paid to shareholders of a corporation, and they are paid out with after-tax earnings of the company. This means that dividends are not an expense of the company and they don't reduce corporate taxable income or corporate taxes owing. The flip side is that dividends carry less personal tax liability than wages because they come with a dividend tax credit. The reduced personal tax from the dividend tax credit is meant to offset the additional corporate tax that will be paid when using dividends. Now that we know a bit about how dividends work, let's look at why you might choose dividends over a salary. Paying dividends removes the need to contribute to CPP, which reduces corporate and personal costs. As of 2023, CPP will cost employees 5.95% on the first $65,700 of their earnings for a total of just over $3,700 per year. Employers also have to match that CPP contribution, so the total cost to the company and the employee is $7,400 per year. The downside of the story is that dividends don't allow you to contribute to CPP, which will reduce the amount of Canada pension you can collect when you retire. Boiling this down, not paying into CPP means more cash now, but potentially less cash later. Another reason to choose dividends is their relative simplicity. If you own 100% of your corporation, you can just declare a dividend and transfer cash from the company to your personal account. Or what's more common in practice is just take the cash as you need it and then declare a dividend for the total amount once per year. There's no need to register for payroll and remit source deductions. You will still have to file a T5 once per year, but it really isn't that difficult. It's a simple filing. And because dividends are so simple, there is less chance that you'll need to pay penalties to CRA. You won't need to make consistent payroll remittances with dividends like you do with wages. Payroll remittances are relentless. Usually they have to be paid each month, and late payments come with stiff penalties. Paying dividends eliminates the chance of late or missed payroll remittances. That being said, filing T5s must be completed on time once per year when paying dividends. For those who know they will struggle to make payroll remittances on time, dividends could be the right choice. Lastly, paying dividends instead of a salary could reduce costs relating to employer health tax. In a few Canadian provinces, BC, Manitoba, Ontario, businesses over a certain size must pay employer health tax. This tax is calculated based on wages paid to employees. Typically, the tax only applies to wages and not dividends, so businesses can avoid or reduce the amount of employer health tax paid by paying dividends rather than salary. Again, this is another item that shouldn't be maybe the sole factor considered in your decision, but it is worth noting. Check out our article linked in the description below for details on the employer health tax. In practice, paying dividends to shareholders of a corporation is fairly easy. Dividends are declared and cash is transferred from the corporate account to the shareholder's personal account in one or many transactions. In practice, you'll often see corporate shareholders just take out money out of the corporation as needed, and then a dividend is declared for the total amount once per year. Then each year, the corporation must prepare and file T5s for any shareholders who receive dividends. The tricky bit with dividends is that they are issued and paid based on share ownership. For example, if Pied Piper Ltd. wanted to issue $100,000 in dividends to the owners of Class A common shares, it must do so based on a percentage of ownership. So if Dinesh owns 30% of Pied Piper's Class A shares and Richard owns the other 70%, then Dinesh would receive $30,000 and Richard would receive $70,000. Now, as you can probably see, this can make it difficult to allocate different amounts of income to multiple shareholders if they all own the same class of shares. For a more detailed look at this topic, check out our article on corporate share structure, which we've linked in the description below as well. Okay, now is a good time to do a quick recap of how each payment type is treated for tax purposes. Salary is a deduction in the corporation and then is taxed as employment income for the wage earner. This reduces corporate taxes, but personal taxes are slightly higher than the dividends of the same amount. Dividend payments are not a tax deduction for the company. They're paid from after-tax dollars of the corporation. And because they don't reduce corporate taxes, they are taxed at a lower rate on your personal taxes. This personal tax reduction comes from a dividend tax credit. The idea here is that total corporate and personal tax should be the same regardless of whether you pay yourself a salary or dividends. Now, this concept is called integration, but you'll find in our upcoming examples that integration doesn't work always perfectly. Sometimes one payment method is more tax efficient than the other, which is what we're going to look at next. Okay, so the most common question we get about salary versus dividends is which method allows me to pay less in tax? So, quick spoiler here, the answer, as always, is it depends. I know that's a very accountant-y thing to say, but it's also true. So, some recent changes to Canadian tax legislation have reduced business owners' ability to split income by sprinkling dividends to other family members. You can find more info on these 2018 tax changes linked in the description below. The updated legislation means that some tax savings from dividends have been eliminated, but we can still do our calculations to choose the option that will save you the most in tax. You can follow along and use a similar method to do your own calculations. The idea is to calculate the total taxes, corporate plus personal, owing if you paid yourself a salary, and compare it to what would happen if you paid yourself dividends. The Wealthsimple tax calculator can be used to estimate personal taxes, and knowing your corporate tax rate will allow you to estimate corporate taxes. Links to both can be found in the description below, as always. In our examples, the year is 2022, and we're looking at an incorporated business in British Columbia. For simplicity, we're assuming that the business doesn't need to worry about employer health tax. In our first example, the business owner wants to pay himself $100,000 per year. On the left side, the owner is paying himself $100,000 as a salary. Here we see that paying wages reduces corporate taxes by $11,000. Then the owner will owe just under $21,000 in personal taxes. And there will be a CPP cost totaling $7,000 after both the employer and employee portions have been paid. The total cost of wages was $16,832 when factoring in a reduction of corporate tax, personal tax paid, and CPP paid. You can then see on the right-hand side that dividends didn't reduce corporate tax at all because they're paid from after-tax dollars. However, the personal tax cost on dividend income is less than with wages. This is due to dividends being taxed at lower rates from the dividend tax credit. Lastly, you'll see that there were no CPP costs for dividends. In this specific example, we can see that a business owner in BC paying himself $100,000 would save about $1,800 in total tax by paying dividends instead of wages. In the second example, the same business owner decides that he wants to pay himself $150,000 instead of $100,000. On the left-hand side, again, we have the payments as a salary. We see that paying $150,000 in wages reduces corporate taxes by $16,500. Those same wages are then taxed on the owner's personal tax return, which will cost him $40,641 in personal taxes. Again, there will be CPP costs totaling $7,000 when paying a salary. This is the maximum CPP cost in 2022. The total cost of wages was $31,140 after factoring in a reduction of corporate tax, personal tax paid, and CPP paid. On the right-hand side, we see again that dividends didn't reduce corporate tax as they are not a deductible expense in the company. Personal taxes were lower than with wages due to the dividend tax credit. And again, there were no CPP costs from the dividend payments. The total cost of paying dividends in this scenario was $32,796. In this version where the owner wanted $150,000 of personal income, paying a salary was less costly than dividends by about $1,600. Total tax amounts are pretty close in both scenarios, and that is often the case. This is why I really recommend taking the whole picture into account when choosing between dividends and salary. Don't just go with whatever option saves you a little bit in tax. I'd like you to also really consider the qualitative aspects that I just discussed. Do you want to create RRSP contribution room so you can invest in your RRSP? Are you concerned about surprise tax bills? How likely are you to get stuck with CRA penalties if you choose salary and make payroll remittances? Do you want to contribute to CPP? Are you going to apply for a mortgage soon? Will paying salary help you qualify for government subsidies or tax credits? Answering these questions will help you make an informed decision. I know that's a lot to consider, and if this all sounds like too much of a pain, you can always call up your accountant. They can help you sort through the issues to make the right choice for your situation. Accountants, after all, eat pieces of tax trivia like this for breakfast.
You're in big trouble, though, pal. I eat pieces of shit like you for breakfast.
You eat pieces of shit for breakfast?
No.
Well, not literally, but you get the picture. And we do love help answering all your general questions on here too. So please don't hesitate to reach out in the comments. If you have enjoyed this video or find it has been helpful for you, please tickle that like button. And if you like content like this or are a small business owner yourself, please consider subscribing. You can even gently caress that bell to get notified when our new videos drop. I see that Paul has found the thesaurus when he's been writing these scripts. So all right, that's it for now. Thank you so much for watching, and we'll see you in the next video. Cheers.